Buffett has a special gift for picking quality stocks and beating the market over the long term. Let's answer together the question, how does Warren Buffett pick his stocks? There must be a way to replicate his success and achieve similar results, or not?
Well, the answer is to control your destiny, which we've been able to do at Berkshire. So we feel no pressure from Wall Street. We don't have investor calls. We don't have to make promises. We get a chance to make our own mistakes and occasionally find something that works well.
What's it going to be about today? Warren Buffett's 5 key questions for stock selection. What type of investor is Warren Buffett? How long does Warren Buffett hold a stock? What investing principle does Warren Buffett consider the most important? Warren Buffett is rightly one of the most successful investors in history. He is known for his value approach to investing. He focuses on the intrinsic value of companies and their long-term potential rather than short-term technical indicators such as moving averages, trending lines or the relative strength index. Through its investment company Berkshire Hathaway, it makes stock purchases. Buffett selects companies capable of generating stable profits over the long term, with an emphasis on good return on equity, quality management, and with intrinsic value below the current market price.
I think that investing has disappeared so much from this huge capitalistic market that anybody can play in, but that the big money is in selling other people ideas. It isn't outperforming.
Let's now list Warren Buffett's 5 key questions for stock selection. What is the company's performance? Buffett carefully analyzes return on equity or ROE, tracking over 5 to 10-year periods, which allows him to get a comprehensive view of the company's financial stability and success. When evaluating ROE, it is also important to consider the competitive environment to get an idea of the market. For example, ROE will be different for a technology company and an industrial company. I will give an example using 2 companies. The first one is a technology company A and the second one is an industrial company B. Although both generate the same net profit and have identical capital, they may have different return on equity ROE values due to differences in the industry. Company A may have higher ROE due to its higher growth and ability to return on investment in innovation. In contrast, Company B operating in industry may have more stable but lower growth, which will affect its ROE. How leveraged is the company? Buffett carefully selects stocks with an emphasis on the financial stability of companies. A key criterion for him is the debt-to-equity ratio, where a high level can be a risk. I'll give an example with Apple, which Berkshire Hathaway holds 50% of the portfolio. As you can see, the debt-to-ratio for Apple has been steadily increasing from 2014 until 2022, where it peaked at 1.95. Currently it has fallen to 1.53. Buffett tracks not only total debt but also the nature of the debt and how it is used. He is cautious about companies with high debt, especially when earnings growth depends on further borrowing, which may be the case in acquisitions, for example. It favors companies with sustainable earnings growth from equity, which signals organic growth and minimizes reliance on new debt. What is the company's profit margin? Buffett emphasizes the evaluation of profit margin. He tracks its historical development over the last 5 to 10 years. In this way, he gets a comprehensive view of how a company's profitability has evolved over time. This approach allows him to identify companies that not only maintain their profitability, but also those that systematically increase it. For Buffett, a long-term stable profit margin represents an important indicator of effective control of operating costs. A company that can maintain a high profit margin over the long term signals its ability to manage its costs effectively and is an attractive investment for him. For Apple stock, we can see that the operating margin has been in the range of a whopping 24% to 31% over the past 10 years. In comparison, Samsung, which also produces phones, has an operating margin of between 11.5% and 26.4% over the past 10 years. Unique business product.
A business at Apple which is larger than our energy business, and we may only own 5.6 or 7%, but our ownership goes up every year. And I don't understand the phone at all, but I do understand consumer behavior.
Warren Buffett often highlights the concept of a moat, a metaphor for a competitive advantage that protects the company from competitors and allows it to maintain stable profits and market share. The moat acts as a protective element around company, representing the differentiating factors or strategies that give it a sustainable competitive advantage. The company has something that differentiates it from its competitors and enables them to maintain their market position over the long term. The competitive advantage can take various forms, such as a significant brand and reputation, low production or operating costs, network effect, innovative leadership or industry regulation. Imagine you decided to sell bottled water. But anyone can do that. Anyone who gets a line and starts filling water bottles can compete with you. In contrast, the uniqueness of the taste and brand of Coca-Cola is associated with only one producer in the entire world.
There were these little silver-like ones in those days, and my grandfather had a grocery store, so I went to my grandfather and I said, how about giving me a deal on Coke so I can sell it around the neighborhood? And he sold me at the rate of 6 bottles for $0.25, and I went around and sold them for $0.05 each. And I sold out every time, and I had no inventory, I had no receivables, I had the best business I ever had. But I made one mistake. I didn't put the money I saved into Coca-Cola stock.
So when Warren Buffett picks stocks, he looks for companies with something extra that sets them apart from the competition. Something that acts as a hedge against competition and can't simply be copied. How far below intrinsic value are the stocks? Warren Buffett focuses on fundamental analysis as a key tool in stock selection. His strategy is to carefully assess how much a stock is trading below its true intrinsic value. The lower a stock's price is compared to its intrinsic value, the better investment it represents for him. There are several calculators for determining the intrinsic value of a stock that Warren Buffett uses. These tools help him identify whether a stock is undervalued or overvalued based on real indicators. What calculators can we use to determine a stock's intrinsic value? In the last video, I discussed Benjamin Graham's calculator that measures the fundamental value of a stock. Another example is the discounted cash flow (DCF) calculator, valuing a company based on the present value of expected future cash flows, or the dividend discount model, which evaluates a company based on dividend payments. What type of investor is Warren Buffett? He is traditionally considered a value investor, although his investment philosophy includes elements of both growth and value approaches. Buffett's strategy is often referred to as value investing at a reasonable price. While Buffett emphasizes the value approach, he is not strictly limited to low value or undervalued stocks. In some cases, he is willing to pay a higher price for a quality company that has a sustainable competitive advantage. It is important to note that the line between value and growth investor is not always clear. And many modern investors prefer a combination of both approaches, referred to as a blend or core and satellite approach. Buffett's approach can be seen as a harmonious combination of these two strategies. How long does Warren Buffett hold a stock? He is known for his long-term investing perspective and strategy of holding stocks for long periods of time. His approach is often referred to as buy and hold. He invests for many years, even decades. Although it is not specified exactly how many years he holds each individual investment, some of his major investments, such as Coca-Cola and American Express, are known to have been held for many decades. Buffett believes that a long-term view of investments and patience are key to achieving success in the stock market. What investing principle does Warren Buffett consider the most important?
By far the best investment you can make is in yourself. I mean, for example, communication skills. I tell the students that come that they're going to graduate schools and business, and they're learning all these complicated formulas and all that. If they just learn to communicate better, and both in writing and in person, they increase their value at least 50%. And, I mean,
Buffett considers continuous education and self-study to be key. He devotes considerable attention to reading books and studying areas related to business and investing. At the same time, he stresses the importance of investing in education as a means of developing skills and a good understanding of the world around him. Buffett sees education as the cornerstone of success. He has invested in educational institutions and engages in philanthropic activities to provide quality education opportunities for the next generation.
but you're going to get one body and one mind, and that's all you're going to get. And that body and mind feels terrific now, but it has to last you a lifetime.
So, did you learn anything new? If so, I'd love it if you give the video a like, and I look forward to seeing you next time. Have a great day. And finally, Buffett's advice. Rule number 1, never lose money. Rule number 2, never forget rule number 1.